Hello, hi everyone. In this video, we'll talk about hedge accounting under Ind As 109, which is on the subject of financial instrument. So specifically, these 6 topics we'll cover in this video. Yeah. So first, we'll talk about introduction to hedge accounting and how to establish relationship between the hedged item and the hedging instrument. And what are the qualifying hedges for accounting under Ind As 109 and what are the hedge accounting concepts, then hedge effectiveness testing, and one CA final exam we'll go through. Okay, so first on the introduction. So the objective of hedge accounting is to fairly represent the effect of entities' risk management initiatives. So an entity might have various risks like the foreign exchange risk, and there are many risks an entity might have, and the entity will also have a kind of the risk mitigation initiatives. And to cover the forex risk, an entity might take kind of the forward contracts, and how to account those forward contract, that's called hedged item. So how to account the hedged item and the hedging instrument to represent truly the financial statement. This is what Ind As 109 talks about under hedge accounting. Okay, maybe a little bit more explanation. We'll talk about one example. Assume the entity have a contract to sell its product in USD currency. So the functional currency of the entity is let's say in INR, but they have a contract to sell their products. Let's say they are exporting their products and they will be getting the consideration in USD currency. Right. The realization of sale profits will happen after 6 months. Okay, it's not immediate sales. After 6 months, the realization of cash flow will happen. Right. So it is hard to predict what would be the exchange rate between US to INR after 6 months. So we cannot predict what would be the exact exchange rate. Maybe we can forecast, but that may not be real. The exact exchange rate, no one can predict. So there is a risk. So if they assume the currency INR to USD rate, let's say it will be 90, but at the end if it is realized at 80, then there is a loss. There can be opportunity also. Against their forecast of 90, the FX can move to 95 also, but it cannot be predictable. So to have a certainty, the entity might enter into a contract. It's called a forward contract. So it's kind of hedging instrument with its bank. So the accounting for such forward contract in the financial statement is hedge accounting. Right, we'll go through a few more examples in the slides to come. Okay, so to follow the hedge accounting, it is necessary to establish relationship between the hedged item, example trade receivables in this example in US dollar, and the hedging instrument forward contract. So there should be a relationship between the hedged item and hedging instrument. So there can be some entity without having hedged item, they will just take some hedging just to gain some benefit out of it, kind of speculative transaction. For those speculative transaction, the hedge accounting will not apply. So unless there is a relationship, hedge accounting will not be applied. So the primary condition to apply the hedge accounting is to establish the relationship between the hedged item and the hedging instrument. Okay, I hope it is clear. Then the next one, Ind As 109 is optional. Right, so Ind As 109 is optional, it's not mandatory. So if the entity wanted to follow Ind As, they are welcome to do so. Okay, that's on the introduction. Then the second topic, steps to establish the relationship between hedged item and the hedging instrument. So an entity need to follow certain specific steps to identify or to establish the relationship between the hedged item and the hedging instrument. So these are the various steps. First, the entity should have a risk management objective. So the objective or the policy should be defined in the company's policy, and there one of the policies should talk about why the hedge is being undertaken. Okay, and the next step is identify the specific risk. So the risk could be the interest rate risk or the foreign exchange risk or the commodity price risk. I mean, just for example, there could be many risks. Okay, so what are the specific risks that's being hedged? That needs to be stated in the policy. Okay. Then third one is identify the hedged item. So hedged item is where the risks have been accounted. So it can be a recognized assets or liability, or it can be a firm commitment or forecasted transaction, or it can be a net investment in a foreign operation. Okay, then the next one is select the hedging instrument. So the primary step is identify the hedged item, and then what are the hedging instruments have been taken to cover the risk. So the hedging instrument can be a derivative like a forward contract, or the interest rate swaps, or forward or options. So there are many products available in the market. Then we have to document the hedge relationship. So between the hedged item and the hedging instrument, the relationship needs to be properly documented. Then the next is assess the hedge effectiveness. So sometimes the hedge may not be effective. So in that case, those hedge accounting will not apply to those ineffective hedging. So unless the hedge is effective, hedge accounting will not be applied. So we'll see when an hedge will be effective and when an hedging will not be effective. So those examples we'll see in the forthcoming slides. Then monitor and reassess. There should be a continuous monitoring of the hedge effectiveness. So as long as the hedge is effective, you will continue to follow the hedge accounting. But once the hedge become ineffective, you have to discontinue the hedge accounting. Done. Okay, so then let's move on to the third topic. So what are the qualifying hedges for the accounting under Ind As 109? So there are three types of hedges that are qualified under Ind As 109 hedge accounting. So one is fair value hedge, the next one is cash flow hedge, and the final one is hedge for net investment in foreign exchange. So we'll see a few examples of how each of these hedges to explain more about their nature. So first it's on the what is fair value hedge. Yeah, fair value hedge seeks to offset the risks of changes in the fair value of an existing assets or liability. This is important. So an entity will have an existing assets and liability in their balance sheet, and those existing assets and liabilities might have some risks, and entity wanted to cover those risks, and they wanted to take some kind of derivative contracts to cover those risks. So the primary condition is for the fair value hedge is for covering the risks of the existing assets and liability. So for example, if an investor has a portfolio investment heavily weighted with the stocks that are part of the Nifty 50. So you must be knowing what is Nifty 50, the top 50 NSE registered companies, and he or she anticipates a general downturn. Then they can sell the Nifty futures. So Nifty futures is a hedging instrument, and so this hedging instrument can offset the expected loss of the hedged item, which is the top 50 Nifty 50 investment. Okay, so Nifty futures is a hedging instrument available in the market to offset the impact of a decline in Nifty stocks. So this works based on the beta assessment. The Nifty 50 Nifty future works based on the beta assessment, which studies the volatility in Nifty 50 stocks. Okay, that's one example. And in the Nifty 50, this example, if the market declines, the losses in the stock portfolio will be partially or fully offset by the gains in the short Nifty futures position. So the hedged item and the hedging instrument works like this. And then another example is hedging of a floating rate bond. So floating rate bond is a hedged item against interest rate changes using the interest rate swap. So interest rate swap is a hedging instrument. So these two are related and will be helpful to offset any adverse interest impact. Okay, so that's on the fair value hedge. Now we'll go through what is cash flow hedge. So cash flow hedge is attributable to a particular risk associated with a highly probable forecasted transactions or a firm commitment in respect of foreign currency. So the primary difference between fair value hedge and cash flow hedge is that fair value hedge is taken to cover the existing assets and liability, but cash flow hedge is to cover the forecasted transaction or any firm commitment. It's still not there in the balance sheet, but the entity expects some risk would be there and they wanted to cover those risks by taking some derivative assets. So in that case, it's called a cash flow hedge. So example, to protect foreign currency transaction, the future foreign currency transaction, and to protect any future interest liabilities. Okay. Then what is hedge for the net investment in foreign operations? Right. So an entity might have many businesses outside of their base country, and so that's of course nowadays it's important for their expansion to have more of a global economic concepts. So in that case, the entity will have a risk of conversion of all their foreign net assets into their local functional currency. So at the beginning of the financial year, the exchange rate could be 1, but at the end of the financial year, the exchange rate could vary. So it cannot be predicted. So for that purpose also, there are some derivative assets or derivative contracts are available in the market. So they can take that contract, and using those contracted rate, they can do the translation. So this will avoid any translation risks. So this accounting is also covered under Ind As 109. Okay, then we'll go through the hedge accounting concepts. So we have to see how the hedge accounting should be followed for each of the 3 types of hedges. So first we'll go through how the accounting should be done for the fair value hedges. So here the hedging instrument is measured at fair value. Okay, at every accounting period, the hedging instrument needs to be measured at the fair value. That's the step 1. And changes in the fair value recognized in the statement of profit and loss. So any between the accounting period, if there are changes to the fair value, the delta needs to be recognized in the statement of profit and loss. Similarly, the hedged item. So we have seen hedging instrument that needs to be accounted at fair value. Any changes should be flown through statement of P&L. Similarly, the hedged item is remeasured at fair value. So both hedging instrument as well as hedged item, both are measured at fair value, and any delta will be flown to statement of P&L. Okay, so at the end, any gain or loss from the hedging instrument expected to offset any gain or loss from the hedged item. So that's how it works. So this is how the accounting for fair value needs to be followed. Done. Okay, now let's go through accounting for the cash flow hedges. So the hedging instrument is measured at fair value. Here also it's measured at fair value, but any gain or loss from the fair valuation of the hedging instrument needs to go through equity or other comprehensive income, and not through P&L. So that's the primary difference of accounting between cash flow hedge and fair value hedge. So fair value hedge, any delta of fair value should go through P&L, but for cash flow hedge, any delta on the fair value needs to flow through other comprehensive income, directly debited or credited to equity account. Right, of course, in the cash flow hedges, as you start accounting the hedged item, then any profit or loss when it is getting recognized to P&L, at the same time you can also reverse the impact from other comprehensive income to statement of P&L. So at the end, once the hedge is fully matured and hedged item is fully accounted, then all the gain or loss both from hedged item and hedging instrument will be flown through P&L. Done. Okay. Then the third, how to account the net investments in foreign country. So here the hedge accounting for the foreign currency risk arising from the net investment in foreign operation will apply only when the net assets of that foreign operations are consolidated. So at the time of consolidation only, this accounting for net investment will happen, not on the standalone basis. So here also the fair value difference delta will flow through equity and then not through P&L account. So in the statement of P&L account, it will hit only when the net investment is disposed. So unless the net investment is disposed, the delta on the fair value will flow through other comprehensive income in equity. Only when it is disposed of, the impact will be posted to statement of P&L. Done. Okay. So now we'll go through how to measure the hedge effectiveness. So hedge effectiveness is the extent to which the changes in the fair value or the cash flow of the hedging instrument offset the changes in the fair value of the cash flow hedges. So if it is expected to offset any gain or loss from the hedged item with any gain or loss from the hedging instrument, if the impact is offset, then we can call the hedge is effective. But if it is not offsetting, then it is not effective, it will become ineffective. Okay, we'll go through one example. So a company expects to receive 1 million USD in 6 months and enters into a forward contract to sell USD at 90 per USD. However, the actual amount received turns to be only 800,000 and not 1 million USD. So here up to 800,000, the forward contract is effective, but the remaining 200,000, the contract taken is not effective because there are no transaction happened for that 200,000. Okay, if the hedge is ineffective, then any fair value gain or loss needs to be posted to P&L account and not to OCI. Done. Okay. So we'll go through one example. Please read this example. So this was asked in November 2020 CA final exam. So please take some time to read this question. Okay, so I have also tried to give summary of question. So here Building and Company Limited had copper opening stock of as on 1/4/2011 of 100 kgs at 70. So the total copper stock opening value was 7,000 rupees. Okay, and they have planned to deliver this to a customer, which is scheduled on 30th September 2011, and the price is fixed in US dollar at $100. Okay, so to cover the risk, they enter into foreign currency futures at that time 76 per US dollar to mature on 30th September 2011. Okay, and spot rate on maturity was only 72, so which means they are gaining from the contract futures, currency futures at the rate of 4 rupees per US dollar. And they are asking us to prepare all the journal entries to affect the hedges as of 1st April 2011 and 30th September 2011. Okay, so the answer is the hedged item here is sale of copper in US dollar. That's a hedged item, and hedging instrument is currency futures contract they have taken, and sale is recorded on 30th September 2011, and sale should be recorded basis Ind As 115. So now they are asking us to give the journal entry as of 1st April 2011. So as of 1st April 2011, no gain or loss on the hedge instrument, because at inception there will not be any gain or loss, because at inception your forward contract rate and the fair value both are same, so the delta is 0, so then no journal entry. And since sale of goods is going to happen only on 30th September, on 1st April 2011 there will not be any journal entry for sale of goods. Okay, then on 30th June, let's see what will happen. So on 30th June, there is a gain of rupees 2 per USD, because your forward contract rate is 76, but your spot rate as of end of 30th June is only 74. So which means using the forward contract, you are gaining $2 per US dollar, 2 rupees per US dollar, and for 100 USD, you are gaining 200 rupees. Okay, so the fair value is 200 into this 200 includes the kind of interest element. They have given 6% per annum, but if you compute for 3 months, it will come to the fair value will come to 197. Okay, so this 6% per annum, so 1.5% per quarter. Okay, so again no sale of goods as of 30th June. So there should be entry only for to record the derivative gain. Since it's a gain, you have to debit the derivative asset for the 197 rupees and then create hedging reserve, which is part of other comprehensive income in equity for this 197 rupees. So this is only one entry we have to make as of 30th June 2011 quarter. Then let's see at the end of maturity what happens. So here you have a gain of rupees 5 per US dollar because your maturity rate is 76, but spot rate on the date of maturity is only 71. So you are gaining 5 rupees per dollar, and for $100 you are gaining 500 rupees. Right. So fair value is 500, and there is no interest because you are realizing that 500 on this date. So the fair value itself at 1, which is 500. There is no need to do further discount there. Okay, so now you have to account for derivative assets and then account for the realization of the sale proceeds. So for the derivative assets, since it's continued to be profit, you are debiting the derivative assets and then creating the reserve through OCI for the 303 rupees, because out of 500 and 197 you already made the entry in the last quarter. For remaining you are making entry now. Okay, then for the sales you have to debit the trade receivables and credit revenue, and this should be done at the spot rate at the time of transaction. So that's how Ind As 115 talks about. So here you should not use hedge rate to account the trade receivables. Here you have to use only the spot rate on the date of transaction, which is 72. So your trade receivable will be debited by 7,200 and revenue will be credited by 7,200. But you are realizing additional 500 rupees, so you can debit bank and then credit the derivative assets. So your derivative assets will become nullified, and all the hedging reserve what we have can be reversed from OCI, and that can be credited to revenue. So ultimately your revenue in total is 7,700, but 7,200 is accounted as part of the spot rate on the date of transaction, and remaining 500 is accounted as part of hedge accounting. Then I think that's it. If you have any doubts, please feel free to put a comment.